All right, welcome everybody. I'm going to make sure we start with Social Security, our top slide here. What we're talking about in this NEA retirement program webinar is how to maximize your benefits from Social Security. Now, you might not be right at the doorstep of retirement right now, but that's okay because you need to know how the system works so that you can also save the correct amount and understand when you're going to take your benefits so that you actually know the answer to the question, am I on track to meet my retirement objectives? So without further ado, if you don't know me already, my name is Daniel Ryan. I'm a certified financial planner, IRS enrolled agent, and I like doing these. I'm your NEA retirement specialist, so I do these monthly webinars to help equip you. If you haven't already, you can get my book on Amazon. It's the Oregon Public Retirement, the Financial Planning Playbook to Oregon Public Servants. You can see that here on the screen. And if you came early during the first part of our waiting time here, you probably saw that there's also a lot of other resources that I've branded with this Oregon Public Retirement. One of them is to get the ebook version completely for free. If you go to my website, ryanfinancialsolutions.com/union-members, you can actually get the whole ebook as well as the audio book. We have podcasts, we have YouTube videos. So I'm trying to get you everything you possibly could need if you choose to do all this on your own. If you're looking for someone to do it for you, that's where we can help. But that is not what everyone wants. A lot of people at the webinars, for example, kind of do it yourselfers, maybe, or at least you're trying to see what's available as far as how people can help guide you through it. If you don't already know, the NEA member benefits has more than just retirement specialists. They have other things like credit cards and vacation, traveling, and car rentals and hotels. You can see a whole gambit of different things here, different insurances, for example, that are available. So whatever you're looking for, I always recommend going here first. And this is the NEAMB.com, and you can find a lot of great resources if you haven't checked this out already. Also, if you didn't know, the NEA retirement program has a sponsored or appointed 403B provider of choice. So if you don't have security benefit on the top of your 403B statement, maybe you have another custodian, because I think there's 14 in your school, then you can check out security benefits, see if that's an option for you. See if it makes sense overall. One of the biggest reasons that Security Benefit has become the national appointed 403B provider is because they have the most investment selection. You can work with an independent financial planner like myself, or you can do it on your own. So Security Benefit really gives you the whole array of investments as well as advice or not if you choose to. If you do want to find out more about the program, I've put my email address there, Daniel@ryanfinancialsolutions.com. So just a few resources that I want to make sure that everyone knows is available to you. If you haven't already been on a webinar in the past, you probably know, but you might not, that you can do question and answer during this time period as well. So if you want to put it in the chat or the Q&A on Zoom, I will be here. I'm actually here answering your questions. So really enjoy doing that and having it be live. So that being said, as we jump into Social Security, quick disclaimer, I'm not giving you specific advice in today's conversation. I'm giving you the tools and the general advice you need so that you can make sure you're making wise decisions with either your financial planner that you have already, or if you're doing this on your own. I don't work for Oregon PERS. I don't work for the union. I don't work for Social Security. I own Ryan Financial Solutions. And you can always go get a free 15-minute phone call if you go to my website, ryanfinancialsolutions.com. So let's jump into today's agenda. We are talking about Social Security, and we're going to talk about not just the basics. We're going to start there, but then we're going to talk about strategies. How do I put this information to use? How do I use that for my favor and my benefit later on? So one of the questions you might have right off the bat, especially being a public servant, is, am I eligible for Social Security? And for some people, you might have come from CalSTRS, which is the California Teacher Retirement System. You might have come from Texas TRS, or you might have come from Nevada. Some of these places don't pay into Social Security. So I don't want to take everything for granted. I'm going to talk about the windfall elimination provision and the government pension offset. But if you have other basically non-Social Security jobs in the government before you came into Oregon PERS, that is possible. So I got to make sure that you know you have to have at least 10 years, or what they call 40 quarters, into the Social Security system. Then they take the highest 35 years. So while PERS is somewhat easy to calculate off the top of your head, Social Security is basically impossible to just give a round number and pretend like it's going to be the same for everybody, because they're taking 35 years of work history and then they inflate it. Basically 35 years ago, your $8 a year salary was not actually $8 in today's dollars. So they do this whole extensive calculation to make sure that you're getting the best bang for your buck. Now, most of the time, and I'll give you some helpful hints here, but I'm not saying this is your situation. Most of the time, if you have been in the Oregon public sector for the last 30 years, you can count on a full retirement age benefit somewhere between $2,000 to $2,500. That would be a normal benefit, but it's probably not going to be very much higher than that. Depends on how far away you are from retirement. So the second part is not just am I eligible, but is it going to be there when I retire? That's another question that folks typically have. And the answer to that is no one has a crystal ball, but it's very, very unlikely that Social Security would ever go bankrupt or the trust fund lose all of its money that it has. I like to rephrase it in a couple of different ways. Social Security right now, you can see on this slide, is saying that by the year 2035, so 10 years or so, they will not be able to pay the total benefits that everyone's receiving. So it says that it'll be paid 80%. What does that mean? It means that if in 10 years from now you start Social Security and it's supposed to be $2,000 per month, Social Security is going to basically give you $1,600 per month. That is so unlikely to actually occur, though, because there's 10 years from now. And the question is, Daniel, have we ever seen this before? The answer is yes. Actually, in 1981, Social Security was almost unable to pay all of their benefits. And in that year, Congress made really swift action. And that's when they changed the full retirement ages of different people. And they taxed Social Security for the first time. And all the Social Security taxation goes back into that trust fund. That made it sustainable for then another 55 years without them changing anything else really since. So could they come up with something in 10 more years? Yeah, you bet. So I would say very, very unlikely. And the entire government, both sides of the aisle, they need to make Social Security sustainable, because it's already been around for about 85 years. It would be extremely unpopular, no matter who you are in office, to let that, quote, die. So the question then becomes, okay, if they started making these changes to full retirement age benefits, what does that really mean? And where do I fall into the categories? For most people, if you are born after 1960, you're going to be a full retirement age of age 67. Okay. For those people, my parents, for example, were in this era of the baby boomers, right? The 1950s. Those folks had a phasing out period. So that means that they were, age 66 in 2 months, 4 months, and so forth. It's kind of silly, but that's how they got this to pass in the 1981 bill that they passed through. Now, the question is, why is full retirement age so important? Well, that's because that's the number that Social Security actually uses for the calculation itself. If you're thinking about PERS, it's a lot like the normal retirement age that PERS uses for their calculations. So for a tier 2 person, if you don't get to 30 years, age 60 is your normal retirement age, and your full retirement age with Social Security is age 67, most likely. So that's just how the calculation is made. If you do take it before your full retirement age, there are penalties, or it's a reduced benefit, maybe is a nicer way to say it. But that's how they go about calculating the benefit overall. So what I've done here is I've put the average of $2,000 per month to illustrate an example. So let's put some real numbers to this conversation. Let's say, for the sake of most of you being on this webinar with me, that you have a full retirement age out of age 67, and it's going to be $2,000 per month if you waited till age 67. Well, if you decided, hey, I'm going to retire as a tier 1, tier 2, maybe even an OPSERP person with 30 years, I might get to 60 or 62, and I might want to take it early. What's the big deal? Well, instead of getting $2,000 per month, you're going to get $1,400 per month. So it's going to be reduced by about 30%. But what if you want to keep working? You just love what you're doing, or maybe you want to stop public service and go work somewhere else, start your own business or work in another state, whatever it might be. Well, then you could delay it all the way up until age 70, and it will continue to grow by 8% each year until you get to age 70. It would be maxed out. And in this example, that would get you to a benefit of $2,480 per month for the rest of your life. So That's a big shift from 8 years, 62 till 70. It just about doubles. If you looked at that 1,400 versus the 24 or $2,500, basically, it almost doubles in that period of time. Now, most people know this, but there's some speculation, especially when I'm talking to police officers and firefighters, as to how long you might be in retirement. Most public servants, especially in education, you are going to be living probably 30 years in retirement. My grandfather is he passed away last year. He was a retired public servant in education, had a 40-year retirement. I don't think he ever saw that possibility even to see that. So most people know this, but in the last 50 to 60 years, the expectancy of life has increased significantly. So now instead of age 66, it's going to be almost 20 years more than that at age 84. So for a lot of you thinking about retirement, you got to think about the longevity. If you've got a 403B and an IAP, you might have lost your money, somewhere in your 70s. It just depends on your spending habits. If your question is also when's everyone else taking Social Security? Most people are taking it at their full retirement age benefit or really close to it. But I don't want this to guide your decision. Okay. If only 10% of people are taking it at age 70, some people read that type of statistic and they say, oh, looks like not very many people are doing it. Maybe I'm missing something. But that's actually not the reason. The reason most people are taking it early is because they have to. Is because they retired before they thought they were going to originally because of health or disability or what have you. Maybe they lost their job and they're not really looking for a new job at 62. And so they just go ahead and take their benefits because they can't make ends meet. So they don't have any other options. So don't take these numbers and say that this is what should guide your decision. But most people are taking it right at their age 66 or 67. One of the reasons you would definitely want to delay your Social Security is if you're still working. So let's give an example. Let's say that you are still working as a public servant and you decide, I'm 65. I'm just going to go ahead and take my Social Security benefits to get that extra income. Well, if you're making more than $22,320 this year, and it changes with inflation, then you will actually have to pay your Social Security benefits back $1 for every $2 over that limit. Let me give you a real number example here because a lot of folks get confused by this calculation. If you're under your full retirement age, which 65 would be by default, let's say that you made exactly $32,320. That's $10,000 exactly over the threshold. And Social Security would say, hey, if you're making that kind of money, you got to pay us back $5,000. That's $1 for every $2 made over the threshold. So you would have to pay back $5,000. Now, if you're making your whole salary, you're going to pay all of it back because you're going to be at 80,000 or 82,000, and your Social Security checks are never going to be that large. So you would end up paying all of it back. So a good reason to delay your benefits just right there is because you are still working full time or you're at least making more than $22,000. Now, on the flip side, if someone was subbing part-time, let's say you had a retirement date of age 62 and you're going to be just subbing here and there, should I take Social Security? Well, potentially, you're probably not going to make more than $22,000 per year. And so you won't have to pay the Social Security benefits back. This is a way of Social Security saying you're mostly retired, so we're okay with you working a little bit. I just like to also point out that this is talking about earned income. Self-employment income, subbing, teaching full-time, or working in the private sector even. This is earned income, does not have anything to do with your pension or your investments or rental income or anything like that. It has to be earned income only. That's the only threshold. This middle one here is the year you're turning your full retirement age. So let's say you're turning 67 in 2024 and you wanted to start your Social Security benefits while you're still working. That is very unlikely, but it does exist. And there's a pretty solid threshold where they almost allow you to make, $60,000. Where people get tripped up is they fill out their Social Security application and they're retired in June and they start their Social Security application and it asks the question, did you work this year? And if you're not your full retirement age yet, and you say, yes, I did work and I made, $8,000 a month or whatever it is, it's very likely that Social Security will delay your benefits until 2025 or January of the next year, basically. So I always like to really help people guide through that Social Security application because while it seems like it should be simple, there are definitely pitfalls. And that's why I do those with my client so that they don't click the wrong button and then delay their benefits unintentionally. So you got to make sure. It seems like a simple question, but if you have not done it before and you will only ever do these applications one time in your life, well, I've done dozens of them, it's hard to know what to expect when you're actually filling out the online application. If you're going to retire after 67 in this example, there's no penalties after that. Social Security is fine if you want to work as much as you want to. Okay. Now, what about taxation on Social Security? I started with this concept that in 1981, Social Security became taxable for the first time. When it came out in 1935, it was not a taxed benefit. It's also still not taxed in the state of Oregon or any state for that matter. So if your question is, how is it taxed at the federal level? That is the right question. And it's not taxed at all at the state level. They changed it a couple of times and they made it so that there's a provisional income calculation, which is a little complex. I'll walk you through the basics here today. But basically what you need to know is it's potentially still not taxable to you. Let me give you an example, show you how this all works. Let's say that you are single and you would fall into this part of the table right here. And let's say that your PERS pension is $1,500 per month, which would be $18,000 per year. And then you say, well, I'm also getting Social Security benefits of $1,000 per month or $12,000 per year. Well, Social Security in their taxation, really it's the IRS in their taxation tables, they would say, well, all of your pension, that $18,000, that counts towards your provisional income all the way. But only half of your Social Security benefit is actually going to count for this calculation. So instead of 12 plus 18, it's actually only 6 plus 18, which is $24,000. That means you're below the threshold, and thus there's no taxation on your Social Security benefit. You might still pay taxes on your PERS benefit, depends on if you're itemizing or you have a standard deduction, but that's a little outside the scope for today's conversation. But that is how the provisional income calculation works. It's a little different if you are married filing jointly, but you can see that there's these thresholds, and that's how we know how much is going to be taxed. Now, let's say that you are making tons and tons of money because of a spouse or otherwise. You have rental income and you have a ton of IRA money or IAP or 403B money. And so you're making way above these thresholds of 44,000 and all that. Well, then if you had $10,000 coming from Social Security, 85% of that will be taxed, which means if you got 10,000, $8,500 will be taxable. Okay. And then it's taxed at your ordinary income rate of 12%, 22, and so forth. Okay. So that's how the tax system works. That's why I do tax preparation, because it has a huge implication when you're doing your overall tax planning as to what sources of income we are going to be deriving our distributions from. For example, if you're looking at 50% of your Social Security benefits count, it's also going to include your tax exempt municipal bonds. We call this the MAGI, or the modified adjusted gross income. A lot of financial planners don't even know that for the calculation of provisional income, we put back in tax exempt income like municipal bonds. Certainly, it includes all the other types that you're familiar with, rental, wages, that kind of stuff. But it does not include HSA distributions like health savings accounts is what that refers to, Roth IRA money. So if you had a pension of that $1,800 or $18,000 per year, and a $100,000 distribution from your Roth IRA, you would still pay no taxes on your Social Security, nor would you pay taxes on your Roth IRA. So really important that we understand the tax implications of your distribution strategy as it relates to Social Security and certainly other topics as well. What about spousal benefits? A lot of people have tons of questions, and I have a whole chapter dedicated to Social Security, and it gives you several examples throughout this so you can see maybe where you fit in Social Security disability or an ex-spouse or a current spouse or what have you. So there's a lot of different variations to this. So what if my full retirement age is, again, 67, and I have a spouse maybe that hasn't been working? And so you're the educator and you're making $100,000 a year. So your Social Security benefit is $2,000 per month. Even if your spouse has never worked a day in their life, they are entitled to $1,000, 50% of your benefit as your spouse if they wait till their full retirement age. So that's critical that it's their full retirement age, not yours as the income earner. So let me show you how this really works in an example coming forward. But what we're talking about is strategies for couples, survivors, and certainly former spouse, ex-spouse categories as well. And I have an example of that with some real money here in a second. The other question you have is, what is the break-even point of whether I take my benefits at 62 versus 70? This is very much a train leaves Chicago at 8 p.m. on Thursday and a train leaves New York, and what time, it's going 100 miles an hour versus 80 miles an hour. When do they collide? And that's the question that we're asking with Social Security. If you tell me when you're going to pass away, I can calculate this very easily. But that is the great unknown. We don't know how long retirement's going to look for you. We also don't know if you need the income on the front half of retirement. For example, a lot of people still have mortgages. So you might think it's a great idea to delay till age 70 because it shows here on the graph, I'm going to get way more in benefits because it's significantly higher payout. But that doesn't matter if you ran out of money and you can't pay your mortgage at age 65. So it's a cool concept, but we got to find the balance. We have all these different sources of income. We got to make sure we know where everything's going to be coming from. So the question in this example would be, if you're planning on living till you're 95 and 87, it probably makes sense to delay your Social Security benefit until age 70 because that's the maximum per month that you're going to get. It usually is a break even of age 82. So don't worry about your calculators. They all say the same thing. They're going to get you basically to 81 or 82 years old. That's the break even where you say, well, if I'm going to live past that, then I'm going to delay until 70. Basically, I'm going to have it for 12 years or more. But again, I go back to that might be a good strategy, but it sounds cool on paper, might not be the best plan for you. So I'm not always a proponent of doing that. And I'll show you why here in a second. The other thing you want to know is a survivor benefits. So what if my spouse passes away during retirement or maybe even beforehand? If you were married to them for at least 9 months and at the time of your spouse's passing, then you are potentially eligible for those benefits at your age 60. It'll still be reduced. It would be higher if you delayed it. But for survivors, you can actually delay either the deceased benefit or your own, depending on which one is higher. You might choose to do that. If you're still working, you're going to have income limitations as well. You're still going to have the taxation on the provisional income and so forth, just as we discussed as well. So what about divorced spousal benefits? A lot of people have questions about this. And basically what happens is if you have a spouse that has tons and tons of money and they made a really good income and maybe you just had to go back to work just now, so your Social Security is going to be really, really small. Well, if you were married to them for at least 10 years before they, before your divorce, then you might be eligible for 50% of their benefit. So let's say that their Social Security benefit is going to be $3,000 per month at full retirement age. You could potentially get $1,500 per month, which is 50% of their benefit. They are not going to know that you're asking Social Security about this. That's also the question I get quite a bit. You might try to think, I'm going to stick it to them. What if they're not claiming their benefits yet? That doesn't matter. They just have to be eligible to claim their benefit. And so that allows you to potentially get access to their basically their spousal benefit. Even if you've been married several times, if each one of those marriages lasted 10 years, Social Security will give you the highest of those marriages, each one that you qualify for. So what about how to use Social Security in your financial planning? If you were saying, well, I got PERS pension of $2,000 per month, I have Social Security of another $2,000 per month, you might be thinking to yourself, hey, if I've got $4,000 coming in, and it's always going to be coming in, then that might cover all of your basic needs. So you might see things like food, clothes, healthcare, shelter, that kind of stuff. That might be your rent or mortgage payment. Then you look at your other things that you don't necessarily have to have. And that would be like travel and entertainment and things like that. You might use your 403B or IAP to fund your discretionary expenses. So sometimes people can simplify things and just make it that easy for you. I'll say that the only time that doesn't really work overall is if your goal is to delay Social Security, for example, you might use your portfolio to bridge a gap. So let's say that you retired at 60, you can't even get to Social Security yet. So you might use a lot of your portfolio from age 60 to 62 and then turn on the Social Security benefit. And at that point, you would reduce your spending, hopefully, from the portfolio overall so that you can maintain then a status quo, so to speak. Okay. So now let's talk about what your next steps might look like as to building this all out. What does this actually look like? And I recommend certainly that the first thing you need is a budget. And I know I don't like to say the B word, right? But budgets really do help you get a reality check. And what I find that the issue is for a lot of retirees, especially or pre-retirees, is they tell me very optimistically what they think their expenses are going to be. And they have to think about them and they're, well, my insurance and my cell phone, it's really not that much. And I say, well, that's really not the reality of your spending though. Because then you look at your bill to Amazon or your favorite restaurant, that's where the money went. Maybe your vacation, and you underestimate those discretionary expenses pretty drastically for a lot of people. So I don't just say do a budget like on Excel because that's worthless if that's not really what you're following. What I do recommend is looking at the last 12 months of your bank statements or credit card statements and total it up and divide it by 12. And that's how you should probably look at it. 12 months is going to give you a pretty good picture as to what things might look like going into the future. Okay, so let's talk about when or why you might take Social Security before age 67 or 70 for that matter. And the reason might be, first of all, quality of life. If you have been given some kind of diagnosis that says you're not going to make it, maybe your family history even, it says you're just not going to make it till 82, where it supposedly breaks even, you should probably take your benefits as soon as possible, assuming you're not working, going back to that problem. The other reason I would do it is the quality of life of health, enjoying your money. So for example, are you going to take that trip to Ireland, if that's always been your dream, or Hawaii or whatever it is? Are you going to take that at 85 or at 62? Well, if you don't have the money at 62, then you might not do these trips when you're 70 or 80 or whatever it might be. So it's a reason that you might want to take those benefits sooner. The other one is expenses that are in the front half of retirement. Let me give you two great examples. Health insurance. If you're 62, you haven't gotten to 65 for Medicare to kick in. And if your contract doesn't allow you to get health insurance from the union, then you might be 3 years in a really bad position. You might have to get Social Security started because you got to pay for your health care during that 3-year period of time. You might also have a mortgage still or some other major expense. Maybe there's kids in college still. Who knows? There's a lot of reasons that the front half of retirement will have more cost. Mortgages, you might have health care, you might have kids getting their life started, and you might just want to travel while you're in good health. So those are all good reasons to take your benefit early. Now, I told you I was going to give you an example with spousal benefits as well. So let's pretend for a second that Mary is the spouse that has not been working in this case. I'm just putting names out there. So just take whatever is appropriate for your circumstance. So if Mary did not have very much work history, Mary's benefit's only $400 per month at age 66. So spouse Bob, his full retirement age is $2,000 per month. So Mary is going to get what we call a spousal increase or spousal adjustment. If Mary takes the benefit at age 66, then Mary will get the full $1,000 benefit. And as you can see on the screen here, it's actually a mixture of both Mary's working history as well as the spousal adjustment. We call this dual entitlement in the Social Security language, because you're getting some on your own work history as well as being a spouse increase. Now, what if Mary said, okay, I'm going to take it sooner than I had expected? And Mary might say, I'm going to take it right at 62 while Bob is still working. And let's pretend for this that their birth date's on exactly the same day so that we keep the math simple. Mary's benefit's going to be reduced to $300 instead of $400. But the spousal increase, she's not getting until Bob starts taking his benefit at age 66. So that will still be $600. But you can see that combined, it's only going to be $900 total. And so that's how the math works. A lot of people get confused by that, and I don't blame you. There's a lot of math going on here. The other thing would be what if Mary said, I'm going to take it at 62, and Bob also says, I'm going to take mine at 62, which then triggers the spousal increase automatically when Mary's 62. then it's going to be reduced on both Mary's own benefit as well as Mary's spousal adjustment, thus creating the lowest point of 720. So you can see that when you claim your benefits as the spouse on either side of this, triggers different events for your other spouse. So there's a lot happening potentially. Now, what if Mary's full retirement age benefit was going to be $1,200 just on Mary's own working history? That means that it was always just going to be based on Mary's benefit. It has nothing to do with the spousal benefit, has nothing to do with when Bob is going to take his benefit. So this is really important to understand only if you have this dual entitlement below the 50% threshold. What is the windfall elimination provision? Going back to the beginning, I talked about some public servants that have not paid into Social Security. That's very rare, but it's still very possible, especially if you're in the city of Portland Police and Fire or FPD&R. That does not pay into Social Security. If you're CalSTRS or Texas TRS and a few others, you have an issue with your Social Security, and that is called the windfall elimination provision. It means that if you take your benefit from your statement and it's supposed to be $1,000, Social Security is going to say, well, you're actually going to get penalized about $500 to $600, depends on when you take it. And so that $1,000 that you were supposed to get, you're going to see it become $400 pretty quick. And that's a really big shock for a lot of people. The only way to get out of the WEP or a windfall elimination provision, if this is something that happened to you, is to actually get more than 20 years of substantial earnings, which is listed for every single year by the Social Security Administration. That would be required. And it's actually not until you get to 30 years that it's completely wiped out. But if you have 20, it starts to phase out. So it's a pretty complex calculation. If you only have 20 years in Social Security, paying into the system, and let's say that you had 10 years in the other pensions that did not pay into it, that's what creates the issue. So you might have enough to get a pretty significant Social Security benefit, but then also be penalized for it at the same time. Now, what about Social Security disability? Some folks, unfortunately, have a circumstance occur and they're forced into retirement before they're even 62. If that be the case, you might be eligible for Social Security disability. And that's happened to a few of my clients. Basically, what happens is we fill out the application. It takes about an hour to do that one. That one's a lot more complex. You got to have doctor's notes and all this other stuff to prove for Social Security to review. And then their review process takes about 6 to 12 months, if you can believe that. But they will go through very in depth and they will say you qualify for disability. And then you might get your $2,000 benefit at age 45. Maybe even 30 or 25. It really depends on whenever this becomes a reality for you. But you might also then become eligible 2 years later for Medicare. So there's a lot of benefit to researching this or working with a professional like myself to guide you through that process, because then you get this retroactive pay. If it takes 12 months, they'll send you a big check. And that will become really important for both tax purposes as well as cash flow planning. Now, the other component to the windfall elimination provision, if you're someone that falls into these categories, is also called the government pension offset. You might even have a spouse, for example, that worked for the old Postal Service, which was under the CSRS, the Civil Service Retirement Plan. And that one was not paying into Social Security. If that be the case, then they will not be able to inherit your PERS pension, potentially. Let's say that your pension is going to be $2,000 per month, but their benefit from the USPS or any one of those other pensions that I've already mentioned is supposed to be $6,000 per month. Well, they would have to get, from your PERS pension more than $4,000 to even get anything. So when you're doing your PERS planning, it's really important for you to know on either side of a spouse that you might not want to choose option 2. You might want to choose a different benefit or give it to a different beneficiary or something like that, because the person you might have listed might not even be eligible to receive it because they have another government pension, and that will then offset the Social Security benefits. So really, really critical for folks to understand how this can affect your circumstance and your specific situation. So what about other beneficiaries? For folks who have minor children under the age 18, you might actually be able to get benefits from Social Security. Let's say that you retire at age 62 and you still have a minor, you could also get benefits from that. Certainly the disability or taking it from a deceased spouse at age 60. There's always a lot of exceptions here. But this is going to be what you need to know for Social Security planning overall. I know I spoke pretty quickly, but I wanted to make sure that we get through all of the different information so that I have enough time for any questions that you might have. Like I said, though, I want to just kind of circle back for a quick second to the Social Security bridge, or the retirement coordinates, I call them in my book. If you know that you're going to have a gap from age 60 to 62 because you're a tier 2 member, for example, you want to plan accordingly for your IAP distributions. You also might want to plan accordingly for any Roth conversions that you would want to do before you turn on your Social Security benefits. So there's so many different aspects to this. In our next webinar on January 28th at 4:30 p.m., we're going to be talking about the question, am I on track to retire? And that's where we're going to take these components now from Social Security, from your PERS, from your investments, and answer the question, if I put all this together, how do I know that I'm actually on track? Or am I just throwing random amounts of money into a 403b and hoping for the best? You want to start to understand how this is all going to come colliding to you so that you can start being prepared as soon as possible. So I'm going to pause here and see if there's any questions. I know we got a few folks here on the webinar, so I'll just see if anyone wants to put anything in the Q&A and answer any of your questions. I'm not seeing any so far, but I'm just going to hang out here for another minute or two and see if there's any other questions. And you can also raise your hand if that's easier for you. You can actually ask the question out loud if you prefer. Okay. I'm not seeing any questions. I really appreciate everybody being here. And again, always tell your union members and building reps, thank you. I love doing these webinars with you guys and just educating as much as I possibly can. If you haven't already, get my book on Amazon or go to the free ebook version on my website at ryanfinancialsolutions.com/union-members, and you can get the free copy of the book there. It has a whole chapter dedicated to all the scenarios that you need to know for Social Security, how to get rid of the government pension offset and WEP and so forth, if that be applicable to your circumstance. Other than that, I really appreciate your time. I hope you guys have a great rest of your year.